This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Don Plotsky of Uinta Partners. Don, thank you for joining us.
Thank you, Hall. Thanks for inviting me.
So Don, how did you get into early stage investing?
Well, we've made some early stage investment, but that's not really the core of what we do. So just for a quick background, my partner, Gavin James, and I were both lifelong fixed income guys, 33, 34 years in the industry. And we were both with a very large fixed income firm, Western Asset Management. As we reached the age of consent, which was 55 and enabled us to take early retirement, get our capital, and go about doing the things we really wanted to do. So what we were focused on is investing our own capital. And we're structured as a multifamily office, so that's our primary function. And we sought out several areas of opportunity, including litigation finance and real estate. But in doing so, we came across a couple of companies that, in one case, we found an opportunity to reach a larger audience. So it's focused on distribution. The company is Chalice Wealth Partners. So we made a very early stage investment, actually as founding investors in that company. And secondly, we encountered a company, Ultra Mortgage Capital, who's a mortgage originator focusing on non-qualified mortgages, bridge loans, fix and flip loans. And that's a product that we've invested in the past, and we wanted access to more of that product. So we made a strategic investment in that firm as well. So really, our early stage investing to date has been those two companies primarily for strategic purposes.
So you're in the fixed income investing market. There's a lot to like about that. What do you look for in opportunities? What's your criteria for getting interested in something?
Well, we're really not in fixed income any longer. That's our background. What we look for are investments, either equity or debt, that provides a significant amount of income in an environment where that's not that easy to come by. So the two things I mentioned, litigation finance and real estate, really are two opportunities that have some unique characteristics. So real estate, I think most people are familiar with, so I'll buzz through that pretty quickly. But in terms of real estate, we're doing equity ownership in value-add multifamily properties. And what that gives us is really kind of a 7 to 10% cash-on-cash yield in those properties. And we're buying them at levels that we feel are not going to be negatively impacted by a downturn in the real estate market. Well, how can that be, right? Value-add. And so these are properties typically that have 10 to 15 years of deferred maintenance. Rents tend to be well below market. We partner with developers who acquire the property. We fund the acquisition. And those developers then set about rehabilitating that property. And once the property is rehabilitated, you can get significantly more income. And these things typically trade off a cap rate, which in effect is a multiple of the income that you're generating. So we're able to increase rents pretty substantially, which increases the value. So we think that's a pretty safe cash generating asset that over time will also provide a capital gain as we realize those value enhancements.
So tell us more about the litigation finance and personal injury. That's a very interesting space.
Yeah, that's the true differentiator in terms of what we're doing these days. And when we came out, we were looking, again, at income-oriented investments. And we knew some folks through the industry who were involved in personal injury, litigation finance. And being fixed income people and structured product guys, they asked us to take a look at some of the numbers. And we started tearing through the numbers, and we were truly impressed with the stability of the yield available in that marketplace. So basically what happens is that when someone is injured in an accident, let's say somebody's walking across the street, they get hit by a taxi cab. They're laid up. They have a lawsuit against the taxi cab's insurance company. Let's say that person is not a person of wealth and they need capital. They need money today because they can't work. So basically, there are funding companies out there who will advance money to those individuals in the short term in exchange for a lien on the award when it comes. So we're not buying lawsuits. We're not necessarily betting on the outcome. This is the law of large numbers. We're buying thousands of cases, and essentially we're able to earn a low to mid double-digit return by funding the funding company. So the funding company is making the advance to the plaintiff. The funding company wants to lighten their balance sheet exposure. They'll sell those advances to us in pools, and we get paid a low to mid double-digit return there. What's attractive to us about that is, one, the level of income. Two, the lack of correlation to anything else that's out there. There really isn't much in the way of economic risk. Certainly there's risk associated with the cases. There's regulatory risk should a state or a series of states crack down on the practice of advancing money to these people. But from an economic perspective, really there's no market risk involved here. So we had made some early investments in this space, and we bought interest in pools of cases. And what we found was it was a very cumbersome investment. So our concept was to create a fund, a limited partnership, where we could have a pool and we would handle the reinvestment for people. So basically, this is a low double-digit type investment strategy that pays out on a regular basis. And again, it's the law of large numbers. We have thousands of cases in the pool, and as it grows, we'll bring on thousands more.
Well, I've seen people in this space before, and in some cases, they cherry pick the deals. They have a criteria for which personal injury suits they take on and those that they don't, and they've got some view as to what tends to be successful outcomes versus non-successful outcomes. It appears you're just doing more of an index type approach where you just take a basket and then some portion of those pay off, some don't, but overall it's a winning formula. How does that work for you guys?
Yeah, I'd say your analysis is fair. We do a secondary underwriting of all the cases. So we're buying advances that were made 12 to 18 months ago. We have a team in place that will look at every one of these deals, make sure we've got the appropriate paperwork, make sure the case is a case we believe will win. And so we are doing a level of due diligence there. But given the volume that we're doing, in many respects, it is an index-like profile in that we're trying to capture the general performance of the market. And over the long term, the performance of that market has been about 90% of the cases settle with a sufficient award to repay our principal plus the fees we would have accrued over that period of time. Another 5%, there's some loss typically involved there, but you recover most of your capital, and then the last 5% is typically a total write-off. But the way we participate is we're really taking a senior interest in these advances, and the funding company retains the subordinated interest. So our low double-digit type return is really very safe up to significant losses in the underlying pools. And to boot, we're buying these things at a discount to the accrued value at the time of purchase. So we've got fairly significant over-collateralization going in, and that over-collateralization increases over time because the fees that they're charging to the plaintiffs or against the case are greater than the fees that we're collecting.
You touched on regulatory a moment ago. Where do you see that going? And are there particular states that are moving forward on that and other states that are not? Or is anybody moving on at the federal level?
Well, there's nothing going on at the federal level. It's really more of a state issue. And right now, we see some scrutiny of individuals and firms within the space, but not generally a crackdown on the practice. The practice, in our opinion, really is one that's truly beneficial to the plaintiff, to us, and to the funding company, in that if you take somebody who doesn't have a lot of money, they're hurt, they can't work for 2 months, they need to pay their rent, they need to pay their medical bills, they are able to get the money up front. And certainly if they wait until the case settles, they collect more. But A, it's not substantially more because the funding company is only advancing 10 to 20% of the potential award. Let's say over a 2 to 3 year period, the plaintiff winds up owing double that amount. After they pay their attorney, they've collected money up front and they collect money on the back end, and they're able to stay in their apartment and they're able to pay their bills during the time they're laid up. So really, I think it is beneficial to them. And I think ultimately when states look at that, they'll appreciate that these people are very well protected in this situation. And if the case doesn't settle, they don't owe anything. They get to keep the money that they were advanced.
Well, a related area to this is the medical procedure case where somebody needs an operation, but they don't have the money for it, but they'll probably get reimbursed and so forth. Do you engage in that area as well?
Yeah, typically that's a portion of what is in these pools.
So sometimes the money is going for staying in the apartment, and sometimes it's going for medical procedures as well. I see.
That's right. That's right.
Well, great. Well, in the last minute or two we have here, what else should we be covering?
Well, I think from our perspective, where your interests and our interests intersect is really in the early stage venture. And I think where we're differentiated in that space is that the early stage investments we've made, the early stage investments we will make in the future are very much strategic. So coming out of large organizations, as my partner and I both are, we are accustomed to having certain, let's say, utilities available to us. And when you go out and you start your own business, they're not necessarily there. So strategic venture investing has really enabled us to extend our reach into distribution and product sourcing. And I think that's really the moral of the story here.
Well, that sounds great. Well, how best for the audience to get back in touch with you?
Yeah, the best way to reach us is to go to our website, which is www.uinta, UINTA, investmentpartners.com, or to email info@uintapartners.com.
Well, great. And just as a side note, can you explain what Uinta is, where that comes from?
Yeah, Uintas are a mountain range near Park City, Utah. So Park City's known for the Wasatch Mountains. That's where most of the ski resorts are. And just to the east of the Uinta Mountains.
Well, that's great. That's good to know. I was not familiar with that, but that's pretty neat to understand. But thank you so much for taking time to join us and share that with us, and hope to have you back for a follow-up interview soon. And with that, we'll finish it out.
Paul, thank you very much.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hutton Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.